Picture this for a second. You pull up to your neighborhood gas station on a Tuesday morning, half asleep, coffee in the cup holder, expecting the same boring fill-up you've done 1,000 times before, and the pump screen lights up with a number that almost makes you laugh out loud because it can't be real. Except it is real. And that same tank that ran you $60 back in January is now somewhere north of 90. And you're standing there doing the math in your head about whether you can still afford that weekend trip to your sister's place in Pennsylvania. That's the America we are living in right now. And if your stomach just tightened a little, trust me, you are not alone, because gas prices have soared about 50% since the war with Iran began on February 28th and are up 28.4% over the year according to the CPI data, with consumers paying a national average of $4.50 per gallon, up from about $3.14 a year ago. And that single statistic is rearranging the household budget of pretty much every working family in this country. Hey, I'm Kunal, the guy behind Failed Finance, and I want to be straight with you from the jump. What we're walking into right now is not just another news cycle blip. It's a textbook supply shock layered on top of an already exhausted consumer. And the ripple effects are going to touch your grocery bill, your 401k, your mortgage refinance plans, and yes, even the price of that Amazon package showing up on your porch tomorrow. So before you scroll away, do me a favor and drop a comment letting me know what a gallon costs in your zip code right now, because I want to see the spread between Houston and San Francisco and rural Ohio with my own eyes. That's the kind of real-world data that beats any government dashboard. Now, the headline event here is something most Americans had honestly never thought about until a few months ago. This narrow strip of water between Iran and Oman called the Strait of Hormuz, and roughly 27% of the world's maritime trade in crude oil and petroleum products goes through that strait. Which means when somebody slams that door shut, the entire global energy system goes into cardiac arrest. Starting on March 4th, 2026, Iranian forces declared the strait closed, threatening and carrying out attacks on ships attempting to transit. And from that point forward, the price action in oil markets stopped behaving like a normal commodity and started behaving like a financial weapon. The International Energy Agency didn't mince words either. The IEA characterized this as the largest supply disruption in the history of the global oil market, and the head of the agency described the situation caused by the war as the greatest global energy security challenge in history. And when an organization that lives for understatement starts using language like that, you pay attention. Now, I know some of you are thinking, Kunal, isn't the US basically energy independent now? Shouldn't we be insulated from all this? And that is exactly the trap that I want to pull you out of. Because despite the United States being the largest oil producer in the world, it is still exposed to the same price shocks as elsewhere, because oil is a globally traded and largely fungible commodity, meaning a barrel pumped out of the Permian Basin in West Texas is priced off the same global benchmark as a barrel from the Persian Gulf. And when that benchmark explodes, your local pump price follows like it's on a leash. And the damage from this isn't just at the gas pump, it's bleeding into every corner of the economy. The Iran war caused oil prices to spike, which then caused prices to rise for gasoline, airfare, and groceries, and it may take a while for conditions to normalize due to the months-long conflict. Let me throw the numbers at you straight, no chaser, because this is where it gets uncomfortable. The Consumer Price Index, a key inflation measure, rose 3.8% in April from a year earlier, up from 3.3% in March. And that on its own would have been a story. But the engine underneath that headline number is even uglier. Energy prices jumped 3.8% in the month and accounted for more than 40% of the headline gain, while food prices also climbed 0.5%, putting the 12-month gain for energy at 17.9%, and the gasoline index up 28.4% annually. And here's the part nobody on cable news wants to spell out for you in plain English. Real average hourly wages slipped 0.5% for the month and fell 0.3% annually, which translates into the most painful sentence I can write for a working American. You are getting a pay cut and you didn't even ask for one. That is the definition of losing ground. And as Heather Long, chief economist at Navy Federal Credit Union, put it, inflation is the key drag on the U.S. economy now. This is hurting Americans. There is a real financial squeeze underway. For the first time in 3 years, inflation is eating up all wage gains. And this is a setback for middle-class and lower-income households, and they know it. Read that twice and let it land. The technical name for this combo platter, high inflation alongside stagnant or shrinking growth, is stagflation, and it's the economic equivalent of a horror movie sequel that the 1970s already made and nobody wanted to see remade. The conflict has echoed the 1970s energy crisis through acute supply shortages, currency volatility, inflation, and heightened risks of stagflation and recession. And the scary part for someone like me sitting here trying to help you make sense of this is that the playbook from 1973 doesn't fit cleanly anymore. The U.S. economy is bigger, more services-driven, more financially leveraged, and way more globalized than it was when Nixon was wearing his disco-era ties. Now, I want to pause for a second and just acknowledge something. Nothing I'm sharing here is a recommendation to buy or sell anything specific. This is educational content meant to help you think more clearly about your own situation, and any move you make with real money should run through a licensed advisor who knows your full picture, all right? Cool, let's keep rolling, because the data isn't just on the price side, it's on the human side too. Energy costs, which have risen notably this year, are mentioned by 13% of Americans, up 10 percentage points from last year and the highest since 2008, tying housing costs as the second biggest concern. And that 10-point jump in a single year is the kind of move you almost never see in survey data unless something seismic is happening underneath the surface. To put that in human terms, think of your neighbor who works construction in Phoenix and has to drive 40 minutes each way to the job site, or the single mom in Atlanta who Ubers between 2 part-time gigs, or the retired couple in upstate New York who heat their home with fuel oil. Every one of those folks just got their household economics flipped upside down, and they didn't get a memo. They just felt it in their wallet. And it gets worse, because the share of Americans who say their financial situation is getting worse is higher now than at any point in the past 25 years. Americans are struggling after years of higher inflation and a recent surge in gas prices due to the Iran war. 55% of respondents said their financial situation is getting worse, and the number is higher than at any point since 2001, even compared with recessions during the pandemic or in the wake of the financial crisis. Read that sentence again, because it tells you something important. People felt better about their finances during a global pandemic that shut down the entire economy than they feel right now. That's not noise, that's a signal. Let me share something with you about Warren Buffett that I think is incredibly relevant here, because the channel is called Failed Finance for a reason. We don't pretend that even the legends get this stuff right every time. Back in 2008, Buffett invested billions of dollars into major oil company ConocoPhillips at a time when oil was at all-time high prices, and the world was at the doorstep of a major economic crisis. He moved aggressively, he scaled the position massively, and then the music stopped. The peak position disclosed in the 2008 annual letter was 84.9 million shares acquired at a cost of approximately $7.0 billion, an average cost basis of around $80 per share, and by the close of 2008 COP, traded near $52 with a paper loss at the snapshot of $2.6 billion. And in his now famous 2008 letter to shareholders, Buffett owned it like a grown-up. Without urging from Charlie or anyone else, I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year. Now, why am I dragging up a 16-year-old mistake from the most successful investor in American history? Because the lesson is screaming at us right now in 2026. Buffett bought oil exposure at the top because the narrative felt unbeatable. Every magazine cover was screaming about peak oil. Every dinner conversation revolved around energy scarcity. Every chart looked like it could only go up. And then reality served him a $1.5 billion humility lesson. In his 2008 shareholder letter, Buffett took full responsibility for the major mistake, citing a failure to anticipate the collapse in energy prices. And though he believed oil prices would eventually recover, the flawed entry point and valuation led him to fully exit ConocoPhillips by 2013 with estimated losses of $1.5 billion. Today, we are looking at a mirror image of that same psychological setup. Fear-driven oil narratives, headlines about $200 barrels, retail investors piling into energy ETFs because everybody knows prices are going higher. So when I tell you to slow down, this is the exact moment in market history I want you thinking about. The crowd is rarely right at the extremes, and chasing performance after a 28% spike in gas prices is exactly how regular folks turn a bad situation into a bankrupting one. Now let's zoom out because the geopolitical picture matters here too. By the end of March, the Brent price had increased by about 65% $46/BBBL to record its highest monthly rise ever. Amid pronounced volatility, prices eased somewhat in early April after the announcement of a temporary ceasefire. Since then, the movement of oil prices have reflected uncertainty about the outcome of negotiations between the Islamic Republic of Iran and the United States to end the conflict and restore regional oil flows. And this uncertainty has persisted amid a blockade of vessels entering or leaving Iranian ports and coastal areas. So we are not even in a clean post-war environment. We're in this messy gray zone where the spigot is half open, half closed, and the market is white-knuckling every headline that crosses the wire out of Tehran or DC oil prices are expected to remain high, with Brent averaging $86 a barrel in 2026 before dropping to $70 in 2027 as supply stabilizes. And that forecast assumes the most acute phase of supply disruptions ends in May, and that oil exports from the Middle East recover and stabilize around pre-war levels by the final quarter of the year. Now I want you to be honest with yourself for a second. When has any geopolitical conflict ever gone exactly according to the base case forecast laid out by analysts in Washington? Almost never, which means the realistic risk you and I have to plan around is the upside scenario, the messy one, where this drags into the back half of the year and pump prices stay sticky through the holiday shopping season. So what does this mean for the Federal Reserve, the institution most of us love to blame and pretend we understand? The Fed is now in the worst possible spot, and I'm going to explain why in language that doesn't require an economics degree. Normally, when growth slows, the Fed cuts rates to stimulate the economy. Cheaper loans, cheaper mortgages, more borrowing, more spending. But when inflation is hot, the Fed wants to do the opposite. Keep rates high, slow the economy, kill the inflation beast. Right now, both signals are flashing at the same time, which is why Seema Shah, chief global strategist at Principal Asset Management, said that the inflation data has likely pushed a Federal Reserve rate cut until December at the earliest, with risks rising that it won't occur until 2027. Let that sink in. If you've been waiting on rate cuts to refinance your mortgage or finally pull the trigger on that home purchase, the calendar just got pushed back, possibly into a totally different political environment. As Chris Zaccarelli, chief investment officer at Northlight Asset Management, put it, given that inflation is heading in the wrong direction and the labor market is holding up, it's very unlikely that the Fed will be able to lower interest rates anytime soon, and it's possible that we may start pricing in rate hikes for next year. Rate hikes in a slowing economy. That's the stagflation trap in 3 words. So here's where I want to get practical with you, because I'm not in the business of doom scrolling. I'm in the business of helping you build a plan that doesn't fall apart when the world does. The first thing to understand is that hedging against energy inflation is not about timing the oil market like some Wall Street cowboy. It's about owning a slice of the supply chain that benefits when prices rise. And that's structurally different from speculating. Think about it like an insurance policy on your own gas pump. The big integrated oil names, the midstream pipeline companies that take a toll on every barrel that flows through their infrastructure. The energy infrastructure REITs that own physical hard assets earning inflation-linked rents. These are the structural hedges that have historically softened the blow of energy spikes for diversified American investors. Assets that historically held up during stagflation include energy stocks, commodities, tips, and quality defensives such as utilities and healthcare. And notice the word historically, because past performance is not a promise of future returns, but patterns do rhyme. Let's talk tips for a minute, because most regular investors I talk to either don't own them or don't understand them. Treasury inflation-protected securities are bonds issued by the U.S. government whose principal value adjusts upward with the official inflation index. So if CPI runs at 3.8% like we just saw, the principal on your TIPS bonds gets bumped up by roughly that amount, and you collect a small coupon on the inflated principal. In an environment where regular long-duration bonds are getting clobbered because real yields are sliding, TIPS are one of the few pockets of fixed income that can defend purchasing power. They are not exciting, they don't double your money, but they do something most assets in a stagflation regime cannot. They keep you whole in real terms. Now let's address something that has been driving me crazy on social media. I keep seeing people post screenshots of triple-leveraged oil ETFs and pretending they're investing in the energy thesis. Look me in the eye through this screen. Those are short-term trading vehicles built for professionals, not portfolio holdings. And the math of daily rebalancing will eat you alive even if your directional call is right. If you've been burned by one of those products, drop your story in the comments because I genuinely want other viewers to hear the warning from a real human, not just me. And then there's commodities exposure more broadly. Broad basket commodity ETFs that hold a diversified slice of energy, metals, agriculture, and softs. The argument for owning a small slice, maybe 5% to 10% of a balanced portfolio, is that these assets tend to move differently from stocks and bonds during inflation shocks, giving you that mathematical magic called negative correlation. The classic 60/40ths template needs modification with a 5 to 10% commodities sleeve and trimmed long-duration bond exposure to withstand inflation pressure. That last part is critical. Long-duration bonds, the 30-year Treasury kind, get absolutely demolished in a stagflation regime, and a lot of retirement portfolios sitting in target date funds are carrying way more of that exposure than their owners realize. Go pop the hood on your 401k tonight and just look at the duration profile. You might be surprised what you find. Real estate is another conversation worth having, because there's a misconception that all real estate is created equal in an inflation regime. The truth is more nuanced. Landlords with short-term leases that can be repriced annually do very well. Things like apartment complexes, self-storage, and certain industrial properties. But landlords locked into long-term fixed leases at pre-shock rates can actually get hurt because their revenue is frozen while their expenses are climbing. Same asset class on paper, totally different outcomes in practice. This is why blanket statements like real estate is an inflation hedge drive me nuts. The devil is always in the lease structure. Healthcare and utilities round out the defensive lineup. People still go to the dentist when gas is expensive. They still take their medications. They still flip the light switch. They still pay their water bill. These businesses have what Buffett famously calls economic moats. Pricing power that doesn't vanish when the consumer is squeezed. They're not going to make you rich in a year, but they tend to hold their value while flashier growth stocks get cut in half. On the other side, cash flow-light growth stocks, long-duration bonds, and growth-sensitive cyclicals tend to be the most vulnerable. So if your portfolio is heavy on speculative tech names that don't yet generate real earnings, this is exactly the environment where those positions get punished hardest. Now let's get into the part nobody wants to talk about, your day-to-day budget, because all the investing strategy in the world doesn't help if you're bleeding cash out the bottom of your monthly cash flow. Start by mapping where the energy shock is actually hitting you. Gasoline is the obvious one, but home heating oil, natural gas for your furnace, electricity rates if your utility is exposed to natural gas peakers, and indirect costs like rising grocery bills from diesel-driven trucking and higher airline ticket prices. They all roll up to one number. Pull your last 3 credit card statements and tally what you actually spent on each category. Most people radically underestimate this number until they do the exercise. Then start looking for the easy wins. Carpooling on the days you can, batching errands into single trips instead of 3 separate ones, dropping your tire pressure check into your weekly routine because underinflated tires can shred your fuel economy by 3% without you ever noticing. If you're working from home, even part-time, those days are gold. Every commute you avoid is essentially a tax-free raise. The International Energy Agency has published guidance on measures to shelter consumers from the biggest impact of the crisis, including remote working and greater use of public transport. So if you've got any flexibility with your employer on hybrid schedules, this is the moment to negotiate. And honestly, if you've made changes that have meaningfully cut your monthly fuel spend, share them in the comments because this is exactly the kind of crowdsourced wisdom that makes the failed finance community what it is. We lift each other up by sharing what actually works in the real world, not the theoretical garbage that gets recycled on most finance channels. If you haven't subscribed yet and you want this kind of plain English breakdown of the macro forces hitting your wallet, hit that subscribe button so the algorithm knows to put the next episode in front of you the moment it drops. Now let's circle back to the stagflation question, because I think a lot of people are throwing that word around without really understanding what it means for their portfolio. Stagflation is the rare combination of high inflation, slowing growth, and rising unemployment at the same time. And the setup is unusual because weak growth normally pulls prices lower. The reason it's so dangerous is that the central bank's normal tools cancel each other out. If they cut rates to fight the slowdown, they pour gasoline on the inflation fire. If they hike rates to fight inflation, they crush whatever growth is left. The April 2026 CPI 3.8% and PPI 6% prints signal that stagflation is no longer abstract, and markets now price roughly a 40% probability of stagflation taking hold by late 2026. A 40% probability is not a base case yet, but it is way too high to ignore in your planning. And here's the punchline that keeps me up at night. Even if the shooting stops tomorrow, the inflation it kicked off doesn't reverse overnight. Economists say that the inflationary effects of the war could take weeks or months to unwind. Even if more oil tankers get through the Strait of Hormuz, it may be a while before the whole supply chain starts working again. If we get some resolution optimistically within the next few weeks, it then might be 2 months for things to start to normalize. And the pessimistic scenario is at least double that, or even longer. That could be 6 to 9 months to get back to where we were in January or February. 6 to 9 months of elevated prices baked in even under a peace scenario. That's the brutal math of supply chain inertia. Think about every plastic product in your house, every package delivered by a diesel truck, every airline ticket priced on jet fuel forwards. Those contracts get renegotiated on long cycles, not overnight. So when somebody on TV tells you the worst is behind us, ask them about contract repricing lags and watch them squirm. We're going to keep going in part 2. I want to walk you through the specific portfolio moves a smart American investor can make right now. The budget recalibration playbook for households earning under and over 6 figures, the under-the-radar industries that quietly thrive in regimes like this, and one massive misconception about gold that I see retail investors get wrong every single time. Stick with me, because the next stretch is where the rubber really meets the road dot. So picking up right where we left off, let's talk about gold for a minute, because I promised you that misconception and I want to address it head on. Every time inflation spikes, somebody on YouTube starts screaming about gold going to $10,000 an ounce, and a bunch of retail investors panic buy at the top, and then they sit there confused 6 months later when the price hasn't moved much. Here's the truth most gold bugs won't tell you. Gold is not a perfect inflation hedge in the short term. It's a long-cycle store of value that performs best when real interest rates are negative, meaning when bond yields after subtracting inflation are actually below zero. When the Fed is hiking aggressively or holding rates high to fight inflation, gold can actually trade sideways or down, even while prices in the broader economy are ripping. So if you're considering gold as part of a stagflation plan, the right way to do it is a small percentage allocation, maybe 3% to 5% of your portfolio, held for years, not weeks, and ideally accumulated through dollar-cost averaging rather than one giant lump sum buy at a moment of peak fear. The same logic applies to silver, except silver has way more industrial demand baked into the price, which means it can get hit harder during a growth slowdown, even as the precious metal narrative is screaming buy. Now let me bring you a fresh case study that drives all of this home, and I'm going to use a hypothetical American family because I think real-world examples land harder than abstract theory. Picture the Reynolds family. Mike and Sarah, both in their early 40s, living in a suburb of Charlotte, North Carolina, with 2 kids in middle school. Mike works as a regional sales manager for a building supplies company, and his job requires him to drive about 120 miles a day visiting contractor sites. Sarah is a registered nurse at a community hospital. Their pre-shock household budget was running just under $9,000 a month, with roughly $420 going to gasoline for 2 vehicles. Fast forward to today, and their fuel bill has ballooned to nearly $640 a month. That's an extra $220 vanishing every single month that used to go toward their kids' summer activities or the slow drip into Mike's Roth IRA. Multiply that family's situation by tens of millions of American households, and you start to understand why the consumer sentiment readings are flashing red. Their first move shouldn't be panic, selling stocks or buying crypto on a whim. It should be tactical. Mike negotiates with his employer for a partial work-from-home arrangement 2 days a week, saving roughly 40% of his fuel cost on those days. Sarah reviews her hospital shift scheduling and clusters her 3 12-hour shifts into 3 consecutive days instead of spreading them across the week, cutting 2 round trips per week. Just those 2 changes, no investment decisions involved, claw back about $130 of that $220 monthly increase. That's the kind of low-glamour, high-impact move that nobody puts in a flashy YouTube thumbnail, but that changes the actual trajectory of a family's finances. Then on the investment side, the Reynoldses look at their 401k lineup and realize they're 75% in a single S&P 500 index fund and 25% in a target date 2045 bond-heavy blend with 0 direct commodity or energy exposure. They rebalance, pulling 5% into a broad commodities ETF, adding a small tips allocation through their plan's available bond options, and tilting slightly toward the energy and healthcare sector funds available in their menu. Nothing radical, no all-in cowboy moves, just incremental adjustments that build resilience over time. I want you to do the same audit on your own retirement account this week, and if you've never logged in to actually look at your fund holdings, that's a problem you need to fix tonight. Have you actually pulled up your 401k and looked at what's inside the wrappers you've been funding for years? Tell me in the comments if that exercise reveals anything that surprises you. I'm willing to bet at least half of you will find at least one holding you didn't even know you owned. Now, let me zoom into a strategy that I think is criminally underused by individual investors, and that's IBonds. Series I savings bonds from the U.S. Treasury are inflation-linked, completely backed by the federal government, exempt from state and local taxes, and they don't show up in any flashy financial media because there's no broker commission to be earned on them. Every American can buy up to $10,000 worth per calendar year through Treasury Direct, plus another $5,000 using your federal tax refund. In a high inflation environment, the composite rate on iBonds adjusts twice a year to reflect actual CPI, meaning your money keeps pace with the cost of living without you having to time the market or pick stocks. They're not a complete substitute for equity exposure, but as a foundation layer in your emergency fund and short-term savings, they crush a regular high-yield savings account when inflation is running hot like it is now. I'd love to know in the comments how many of you have ever even heard of iBonds before today. My suspicion is that this is going to be a discovery moment for a lot of you. Now let's talk about the dividend angle, because in a stagflation environment, cash flow becomes king in a way that growth never quite manages. The companies that have consistently raised their dividends for 25 or more consecutive years, what the industry calls the dividend aristocrats and the dividend kings, have historically held up well precisely because they tend to be in defensible, cash-generating businesses with pricing power. Consumer staples giants that sell the toothpaste, the detergent, the cereal that you buy, whether the economy is booming or sputtering. Utilities that get rate-base increases passed by regulators when their input costs rise. Pipeline and midstream companies that earn fee income on every barrel and every cubic foot that flows through their network. None of these are guaranteed winners, and none of them are immune to drawdowns, but as a category, they offer something most growth stocks simply cannot. Real cash being deposited into your brokerage account every single quarter. Money you can either reinvest, redirect to other opportunities, or use to offset rising household expenses. That last option matters more than people realize. If your dividend income is rising at roughly the rate of inflation, your portfolio is essentially functioning as a real economy income stream, not just a paper asset balance you check on a phone app. Now I want to switch gears and talk about something that doesn't get enough airtime. What's happening to American small businesses in this environment? Because if you own a small business or you work for one, this part matters. As the conflict persists, The oil shock has put upward pressure on food prices as well. An increase in diesel prices affects the transportation costs of trucking food to grocery stores. And it takes some time for the fuel surcharges that are built into these contracts to work their way through the system. Small business margins are getting squeezed from both ends. Input costs are rising, but customer price tolerance is dropping because consumers are stretched. The restaurants that source local proteins are watching their beef costs spike. And remember, beef prices rose 14.8% year over year according to the CPI data, which for a small steakhouse operator is the difference between profit and bankruptcy. If you're a small business owner watching this, your action items are concrete. Review every supplier contract for fuel surcharge clauses, ask vendors about index-linked pricing versus locked-in pricing for the next 6 months, and consider whether it's time to raise prices in small increments now rather than a giant catch-up later that will alienate your customer base. The mom-and-pop operations that survive stagflation are almost always the ones that adjusted early, in small steps, while their competitors waited for things to normalize. Things don't normalize when they should. That's the painful lesson of inflation regimes throughout American history. Speaking of history, let me bring up something that I think is one of the most underappreciated pieces of context in this whole conversation. Look at what happened in the airline industry. Airline fares rose 20.7% over the past 12 months according to the CPI data. And on top of that, jet fuel in North America has spiked 95% since the war began, causing multiple airlines to raise prices for checked baggage, and shipping services such as the United States Postal Service, Amazon, and FedEx implemented fuel surcharges. And the breaking point already happened for at least one carrier. On May 2nd, 2026, Spirit Airlines ceased all operations citing rising fuel costs despite the Trump administration's attempts to save the company. That's not a stock chart pulling back. That's an entire publicly traded airline going to zero. If you held Spirit shares as part of a buying the dip strategy in early 2026, you got wiped out completely. This is the part of investing in supply shock regimes that retail traders learn the hardest way. Companies with thin margins and high fixed costs that can't pass input costs along to customers can vanish, not just dip. Which is why I want to make this point as clearly as I possibly can. Checking the balance sheet, the operating margin, and the debt load of any company you own is not optional in this environment. It's survival hygiene. Now there's a flip side to this story that I want you to hear too, because it's not all gloom. The US benefits from the surging oil prices as it is an energy powerhouse. And on April 24th, US exports of crude and petroleum products rose to nearly 12.9 million barrels a day, which means American energy producers, refiners, and exporters are quietly having the kind of year they only dream about. The economic pain is real for consumers, but the economic benefit is also real for an entire ecosystem of American workers, shareholders, and Gulf Coast communities. This is what makes stagflation policy so hard. The people getting hurt and the people getting helped are sometimes in the same country, sometimes in the same family. As James McCann, senior economist for investment strategy at Edward Jones, put it, the good news is that the economy looks resilient to this price shock so far. Many consumers have benefited from tax refunds this year. Hiring has picked up from near stagnant rates in 2025, and businesses are generating robust profit growth. So the picture isn't uniformly dark, it's bifurcated, which makes thoughtful portfolio construction more important, not less. Let me give you a strategy that I rarely see discussed in the personal finance world. The idea of intentionally building an anti-fragile emergency fund in a stagflation environment. The traditional rule of thumb is to hold 3 to 6 months of expenses in cash. But cash sitting in a regular savings account at 0.5% interest is losing 4% of its purchasing power every year right now. That's not safety. That's slow-motion theft. The smarter play is to ladder your emergency fund. Keep maybe 1 month of expenses in immediately accessible high-yield savings, another 2 months in short-term treasury bills earning the prevailing yield, and a remaining couple months in IBonds for the inflation linkage. All of it is essentially risk-free in dollar terms, but it doesn't bleed real value the way pure cash does. That structural tweak can save the typical American family thousands of dollars over a multi-year inflation regime, and it requires zero ongoing management once it's set up. Now I want to address the housing question because I know a lot of you are sitting on the sidelines wondering if you should buy, sell, refinance, or just curl up in a corner. Here's the honest answer. The housing market is essentially frozen right now because mortgage rates aren't coming down on the timeline anybody expected. Sellers don't want to give up their 3% legacy mortgages, and buyers can't afford the payments at 7% plus rates. Energy inflation is making this worse in a way that doesn't get headlines. Utility costs are now a bigger line item in the typical American homeowner's monthly budget than they were 3 years ago, which effectively raises the all-in cost of ownership even if your mortgage payment hasn't changed. If you're shopping for a home right now, my unsolicited advice is to weight energy efficiency much more heavily than the typical buyer does. That means caring about insulation, window quality, HVAC age, and increasingly, whether the home has any solar capacity or is wired for it. A house with $400 a month in utility bills versus one with $250 a month is effectively the same as a $30,000 price difference on the mortgage. But most home shoppers never run those numbers. Be the buyer who does. Let me touch on a topic that I think is going to become the next big controversy in personal finance: electric vehicles in a stagflation regime. The instinct, when gas prices are at $4.50 a gallon, is to assume that everybody should immediately rush out and buy an EV. But the math is more complicated than that. EVs have higher upfront costs. The federal tax credit situation is shifting. Charging infrastructure is uneven across the country, and electricity rates themselves are creeping higher in regions that rely on natural gas peaker plants for grid balancing. Since oil is mostly used in the United States for transportation, continuing to electrify the vehicle fleet and increasing vehicle efficiency standards would help protect consumers from the next shock, so the policy direction makes long-term sense. But for an individual household making a purchase decision today, the right answer depends heavily on your driving patterns, your local electricity prices, your access to home charging, and how long you plan to keep the vehicle. If you drive 60 miles a day and have a garage with a 240-volt outlet, the case for an EV is much stronger right now than it was 3 years ago. If you drive 12 miles a day and park on the street in a city, an efficient hybrid is probably the better economic choice. Run the actual 5-year total cost of ownership math before you let any salesperson or any YouTuber talk you into a decision. Now I want to circle back to portfolio construction with a piece of context that connects directly to what we discussed about Buffett in Part 1. The Oracle of Omaha eventually learned from his ConocoPhillips disaster and reset his approach to energy investing, becoming much more selective. Berkshire Hathaway bought Occidental Petroleum stock when it was down 30% from its highs in February 2025, and Buffett aggressively upped his stake by 763,017 shares on February 7, 2025, bringing total holdings to 265 million shares, or 28.2% of the company. The lesson here for the average investor isn't to copy Buffett's specific picks. Please don't do that mechanically. The lesson is the timing principle. He bought when the stock was down sharply, not when it was up sharply. He bought into pessimism, not into euphoria. That's the discipline that separates the legends from the rest of us. Right now, the typical retail behavior I'm watching on social media is the exact opposite. People are piling into energy after a massive run, chasing the narrative, buying high. If you're tempted to make a big move into energy right now because of everything we've discussed, I want you to seriously ask yourself whether you would have made the same move at $40 a barrel a few years ago. If the answer is no, your conviction isn't about the energy thesis, it's about recent price action. And that's almost always a bad reason to invest. Drop me a comment letting me know if you've made an investing move in the last 6 months that you're now second-guessing. There's no judgment here. We all do it, including the legends. The point is to learn the pattern so you don't repeat it. Now let me give you the practical action checklist for getting through this stretch, because I want you to leave this video with concrete steps, not vague principles. Step 1. Pull all your monthly expenses into a single spreadsheet or app and tag every category that's directly or indirectly exposed to energy prices. You'll be shocked how many lines have indirect exposure. Step 2. Calculate your real wage growth by subtracting your personal inflation rate from your nominal income change over the last 12 months. If that number is negative, you have a household income problem that needs to be solved either through higher earnings or lower expenses, and probably both. Step 3. Audit every investment account you own, including old 401(k)s from previous employers that you've been ignoring, and check the actual sector allocation. Anything more than 15% in any single sector other than broad indices is concentration risk you should be aware of. Step 4. Review your insurance deductibles, because cash that's locked up in low deductibles is cash that's not earning anywhere near the inflation rate, and many families are overinsured on minor risks while underinsured on catastrophic ones. Step 5. Have an honest conversation with your partner, your spouse, your parents, or your adult kids about the financial reality of this moment. The shame and silence around money problems is one of the biggest reasons families don't adjust until it's too late. As Mark Hamrick at Bankrate said, consumers are currently trapped in a double squeeze, wrestling with both the acute pain of the gasoline price spike and the slow rise in other core budget items. And households will find it harder to shift budget dollars from one category to another when most major categories are becoming more expensive at the same time. That double squeeze is real, and it's the kind of financial pressure that quietly breaks families if they don't get ahead of it. Step 6. And this is the one I want to end on. Protect your time horizon. The biggest mistake regular investors make in a regime like this is making panic decisions on a one-year time frame when their actual investment horizon is 20 or 30 years. Stagflation is painful, but it ends. The 1970s ended. Every crisis you've ever lived through ended. And the people who came out the other side with their wealth intact were not the ones who got every macro call right. They were the ones who built durable systems, stayed diversified, kept earning and saving through the noise, and resisted the urge to make permanent decisions based on temporary conditions. None of what I've shared today is personalized financial advice. Your situation is unique, your goals are unique, and a conversation with a licensed fiduciary advisor is worth far more than any video on the internet, including this one. But if this breakdown helped you connect some dots that the cable news anchors aren't connecting, do me one small favor. Share this with one person in your life who's feeling the squeeze right now and doesn't know where to start. That's how failed finance grows, one honest conversation at a time. And that's how we build a community of Americans who are tougher, smarter, and more prepared than the headlines give us credit for. Drop a comment below telling me which strategy you're going to act on first. I read them, I respond to as many as I can, and your perspective genuinely helps shape the next episode. Stay sharp, stay grounded, keep your head when the world is losing theirs, and I'll see you in the next one.